Real estate versus stocks. Everyone online is lying to you about which one actually builds more wealth. I put real numbers, real returns, real estate investing, stock market investing, passive income, and net worth growth head to head, and the answer surprised me. If you're trying to build wealth in America right now, decide where to put your money and retire early. Stay with me because by the end, you'll know exactly which asset class fits your financial goals, your risk tolerance, and your timeline to financial freedom. This is the real estate versus stock market debate, broken down with actual math, average annual returns, compound interest, leverage, cash flow, appreciation, tax benefits, liquidity, and long-term wealth building. Whether you're a first-time investor, a real estate investor, or someone maxing out their 401k and Roth IRA, this comparison will change how you think about investing in America. Let's start with hard numbers. Over the last 50 years, the S&P 500 has averaged around 10% annual return before inflation, roughly 7% after inflation. Real estate nationally has averaged closer to 4 to 5% annual appreciation. On paper, stocks win, but that's not the full story. Because real estate uses something stocks rarely give the average person. When you buy a house with a 20% down payment, you're not earning returns on your cash. You're earning returns on the entire property value. That single fact is why real estate investors often outperform stock market investors on a cash-on-cash basis, even with lower appreciation. Stocks give you compound growth, dividends reinvested, index funds compounding quietly in the background, zero phone calls, zero tenants, zero repairs. Real estate gives you monthly cash flow, rental income, and forced appreciation through renovations. If you want passive income today, rental properties win. If you want hands-off long-term compounding, index funds and ETFs win. This is the core trade-off nobody explains clearly enough. Real estate has tax advantages, stocks don't. 1,031 exchanges, mortgage interest deductions. But it also has hidden costs, property taxes, maintenance, vacancy, insurance, and closing costs that can eat 8 to 10% of your purchase price. Stocks have almost none of that. Your only real costs are expense ratios and capital gains tax when you sell. Liquidity matters here too. You can sell stocks in seconds. Selling a house takes weeks or months. Stock market volatility feels scary because you see the price every day. Real estate feels stable because you don't get a daily price update. But that doesn't mean it's less risky. 2008 proved that. The real difference is emotional volatility versus financial volatility. Stocks test your patience. Real estate tests your cash reserves. So, which one actually makes you more money? The data says a diversified stock portfolio historically outperforms real estate in pure return percentage. But real estate, through leverage and cash flow, can build wealth faster for people willing to manage property and take on debt responsibly. The wealthiest people don't pick one. They build a stock portfolio for long-term compounding and real estate for cash flow and leverage. That combination, not the debate itself, is the real math behind lasting wealth. If this breakdown helped you understand real estate investing, stock market investing, and building long-term wealth in 2026, subscribe for more finance breakdowns like this every week. And tell me in the comments, are you team real estate or team stocks?